the boss.
I hear my background. Like I'm in a meeting, but can you?
Yes, I'm with you. Yes, I can hear you.
Like not me. Can you hear my background?
Yes, I can hear you, but I can't hear your background. I can hear you friendly.
Okay. Because like I'm in another meeting, so I'm trying to confirm if it's not.
Yes, but the background is still like it still shows you are and up to something currently, but I can still hear you friendly.
Okay.
I can share the this thing today, but as you hold on.
No, no, no. I'm going with it. Once I meet you, I'm like, I don't think it should be with you.
Okay, let me share with them. Good evening, everyone. Please confirm if you can hear me.
Good
Good
evening, sir.
evening.
You're welcome, sir. How was the weekend like, sir?
It
Good
was
evening,
fine.
sir.
How's your
You're
weekend
welcome,
also?
sir.
Also, you
We
have a
thank God.
stress-free weekend.
Not stress free, oh.
Not
Stress
stress-free.
free for this year in view.
Ah,
just
stress
as
free.
you have
Okay.
a
When
stress-free
exam
weekend.
remaining how many weeks?
Okay.
Well, we thank God for His grace, sir.
That's fine. That's fine. So, how's the preparation going?
Ah, we are preparing, sir.
Hope you are preparing, sir. Please, start preparing. If you have not, please.
Okay, sir. Thank you, sir. Okay, sir. Thank you, sir. Thanks for the encouragement, sir.
You're welcome. So, our last class, we treated source of finance, equity. So, do you have any concern about that before we move forward to our debt? I told you during the business class, we'll be having what they call it, a robust kind of question that incorporates equity and debt. You understand? Because the one we did last time was equity only, but in the exam, the question we'll be given will be both equity and finance, like a question based on both aspects. So I should confirm. I'm going to confirm if we have a deep understanding of the equity parts before we move forward. So does anyone have concern? Okay. So Mr. Isaac Jimo, we are with you. Hello.
Good evening, sir.
Yes, good evening.
Thank you very much, sir. Please, can you do just overview of what you have taught on what you have said on equity, so that we just build it on what you have said so far
I
on
shared
this new
the
topic.
I shared the what do you call it? I shared a material about that. So just let me know the one you have a concern. If I start, let me summarize. We take a lot of our time because this is a fresh topic itself. Like a random topic for source of
Oh,
finance. But if you have any concern, I go through that one. If you have any concern, we can actually treat that. You
okay, sir.
understand?
Thank you very much. Oh, thank you very
So,
much, sir.
but if you don't have the material, you can reach out. I can share the material with you
No, no, I have
for
material with me.
yes. So what we are doing
Okay.
also, just the question we'll be treating, we still be referring to equity as well. So we have been refreshing what we taught last week. So we can start now, right?
The time has gone a
Okay.
little bit.
Yes.
So source of finance debt. So as we all know, the categories of the financial statement of equity and liability. So we have the equity and debt. That's why if you want to raise finance as a company, either you use the equity, and as we explained earlier, equity you have a retained earnings, or you have to like raise shares. So, and the second part is debt. So debts this involve borrowing from banks, so or sale of debt securities like debentures, bonds, and loans. So I assume we know the meaning of debenture, right? So and bonds as well. So by a company, which is the issuer to investor, probably referred as the bondholders. So in the bond market, probably to West Finance. So these debt security or bond that usually have market value, which is different from the face value. So bonds usually have a market value, which usually are different from the face value. So the face value of a bond is the amount the body holder will receive at maturity, That's the original value of the bond or the nominal value of the bond. Why the market value, this is the current price the bond is trading for in the market, which can be higher or lower than the face value depending on the interest and demand. So it is the interest and demand that will determine the market value of the bond, which whether the bond will rise or it will reduce. Just like normal demand and supply, how it takes place. So bond is can be irredeemable or redeemable. I know if you have done bond valuation, you should have at least have the better understanding of what I'm trying to explain. Bond usually split into two. We have the irredeemable and redeemable bond. So debt capital might be irredeemable or permanent. However, irredeemable debt is not common, and virtually all debt is redeemable. You can see. So, I mean, in the short notes and the wider view, we don't have a bond that is redeemable. All bonds are actually redeemable, virtually redeemable. So, the features of a redeemable bond. Number one is the face value. Like I said, like nominal value of the par value. So the face value of the bond is usually 100 or 1,000. Then these are just terminologies like you must be conversant with when you are hearing anything bond. So when you are hearing anything bond, you must be conversant with all these features. So number two is the coupon. The coupon is annual interest payable to the investor in bond. So the coupon, so if you have a bond so the coupon rate is usually together with the bond. So it's the interest payable on that particular bond. Then you have the current market price, like I said, like I explained earlier. So in the question, when you are not giving the market value of a bond, so it's usually gotten using is the present value of annual interest plus the present value of the redemption value. So those are the terminologies you'll be conversant with when you are in anything bond or when you are associating or relating with anything bond. So we also have the maturity date. So maturity date is the when the debt would be repaid by the issuer. So that's the maturity date. Then you have the redemption value. So this is the amount the bondholder will bought the back by the issuer at maturity date. So it may either be per or payment or discounts. So redemption value is the amount that the bond we bought. So at by the issuer. So at the maturity date. So you also have the yield. So the yield is the cost of the bond to the issuer. So we have the advantages. If you want to raise a bond, you have to determine if you have as a source of finance as a company. So and you want to raise a source of a finance, probably for a project or for other ends. So you can determine whether you are taking equity or bond. But there are some advantages where debt securities have over equity. So some of the advantages is that the principal will be repaid to the investor at maturity date. So if you are using the debt to finance your project or financial company, so the principal of the bond will be repaid at maturity date. So you won't use your principal. So that's the advantages when you are using bond over equity. So another advantage is that so the when the company makes profits or no whether the company makes profit or not, the annual interest on the debt instrument has to be paid to the investor. So whether a company is making profit or not, you are not concerned about that. So your own concern is that you are paying your interest on that particular bond every year. So if you buy a debt security now, probably let's say a particular company trading on the floor of the stock exchange market. So whether the company is making profit or not, so you are not concerned about that. Your own is that they are paying your interest as at when they. So that's the advantages of debt instruments. So The dividends should only be paid if profits are made. So if you're using equity, so when a company is not making profits, so you'll be paid dividend. You understand? So except whether if this is cumulative with them, probably they will be paying accumulating those dividends. But or in normal notes, you won't be paid dividend when a company is not making profit. But debt, you'll be assured, they will be assured you're paying your interest as a vendor. And the third advantage is that in the event of liquidation, investors in debt instruments will be settled before equity holders. So you can see, so if a company is winding up or the company is on the date of liquidation, so they are winding up, you understand? So the what they call it, the equity debt holders will be settled first. So they pay the debt holders first, then before confronting the equity holder. So you are sure of your repayment. And also, risk of default on principal repayment is reduced if the debt instrument is legally secured on some of the company assets. Of course, when a companies take debts, or when you give a particular company a debt and you what do you call it, and the debt is secured by the asset of the company, you know, even though the company doesn't repay you, so you can actually use that asset to set off the debt the company is owing you. That means so your debt is secured. So those are the advantages of using debt securities over equity. So the disadvantages of using a debt over equity is that so the return on investment in debt instrument is fixed. So as such, where the company's profits go, investors in debt instruments do not benefit from that. Of course, when, for example, you borrow a particular person a certain amount and the interest is fixed, let's say 10%. You know, whether the companies make profit or not, your own concern is the 10% you are actually collecting. You're actually um, coping back. You understand? So whether the companies makes more than billions or 10 billions, it doesn't concern you. So what concerns you is what is the fixed amount of interest you are actually earning. So that's the advantages. And also the market value of bonds is unstable and may lead to capital loss. Like we said, so the market value fluctuates of bonds is fluctuates. So it's actually at play of the demand and supply, whether the demand and supplies varies. So when the demand is much, the price will change. When the supply is much. So that's just the advantages of using debt over equity. So are we on the same page?
Yes, sir, we're
Yes,
on the
sir.
same
Good evening.
page, sir.
Yes, sir. We
All
can
right.
hear you, sir.
All right.
Yes, we
I
are on
thank
the same
you.
page.
All right. So, so we also have redeemable bonds with embedded options. So, so redeemable bonds. You know, I told you. So bonds, no bonds are irredeemable. So most of the bonds are redeemable. You understand? So the redeemable bonds with embedded options. So this includes number one, the callable bond. So this bond gives the issuer, like I mean the company, the right to but not the obligation to buy back the instrument prior to maturity dates at a pre specified price. So that's the callable bond. So you also have a putable bond. So this bond gives the bondholder the right to sell back the instrument to its issuer, like the company, prior to maturity date at a pre-specified price. So just like more than opposites of that. But the one actually concerned is the convertible bond. So this bond gives the bondholder a right but not obligation to convert the debt instrument to ordinary shares at maturity dates. So this right to be exercised if the value at conversion is higher than the redemption value. So the convertible bond gives the bondholder the preference or the choice to actually convert to equity or ordinary shares. So, but it will depend on whether which higher probably the conversion or the reduction value, which is higher. So, if you want to convert, if the conversion value is higher, then you convert to equity shares. But if the redemption value is higher, so you have to like maintain your bond and not convert to equity shares. So it just depend on which one is higher there. So we have the advantages of convertible source. So if, for example, as a bondholder, and I want to convert to ordinary shareholders, so I want to become a part of the shareholders having a share in the particular company. So what are my advantages? What are my benefits? So these are a practical question. They might not tell you what are the advantages. They just say, okay, oh, probably so person wants to convert. So what are the benefits for a person that want to convert to equity shares? So benefits. So it's such same thing as advantages, but they might just be the practical question. But once you understand all this, you are good to go. So the advantage of convertible as a source of finance for companies, so is that so the interest rate on convertible is lower than the interest rate on similar straight bonds. So as a company, so if you want to convert to ordinary shares, so the interest on convertibles, that the interest on the loan, so the bond you are having, so is lower than the interest rates on similar straight bonds. You understand? So the normal straight bond that is not convertible, so the interest is higher. But if the bond is convertible, the interest will be lower. That means if you are if the bond is straight bond, so the interest will be earning is higher than when the bond is convertible. That's what it means. So the interest payment is allowable for tax purposes. That is also the interest on the if the bond is convertible, so the interest there is tax allowable. So it will be deducted when they want to compute tax for tax purposes. So number three, there is strong demand for investors for convertibles. So and companies can respond to investors' demand by issuing convertibles in order to raise more capital. So there is obviously strong demand for convertibles bonds. So, but advantages of convertibles, but as a source of finance for investors. So, me as an investor, so what are the advantages a convertible bond will give me, or we so the advantages of investors for a convertible bond is that the investors receive a minimum amount of interest annually, so up to conversion dates. So you'll be receiving a minimum amount of interest annually. So if you are converting from the periods the bonds start counting to the conversion date, should be any certain interest. So and if you don't want to convert, the interest continue. So a second one is that the investors in convertibles will be able to benefit from a rise in the company's share price. So if the share price increases, so the investor that's in convertibles also benefit from the increase in share price. Number three is that the convertibles combine some fixed annual income and opportunity to benefit from a rising share price. So it's still the same thing. So the risk for investors in convertible is that the share price will not rise sufficiently to make conversion worthwhile. So even though the share price is increasing, so it will increase in a way that will meet up the convertible. You understand? So and when this happens, it would have been better to invest in straight bonds, which would have been which have paid higher interest. So like I said, so interest on straight bonds is higher than interest on convertible, because convertible they feel like you can still convert to other shares, you can still be part of the owner of the company. But a straight bond, that is straightforward. You don't want to be part of the owner of the company. So just give me my interest as I went due. So the interest on that will be higher, of course, because convertible is still like you are still your one leg is inside, one leg is outside. You understand? So those are the advantages of using a convertible as an investor, because the interest received on straight bond will still be higher than the interest being paid to convertible bond holders. So this is illustration one. So a Yiga Group PLC has an issue a 10% convertible bond. So the current price is 142 naira, so per 100, and it is convertible into 30 ordinary shares per 100 in 2 years. In 2 years' time, and if not convertible, it will be redeemed at par. So the current share price is 14 naira, and this will increase by 3% per annum. So although this question, I just have to like use this illustration. Though we still have a robust one at the end. I don't know if you can just treat this or we move forward. So we still deal with a more practical question that incorporates our data finance. So we can still move forward, and I'll explain this. So this is just that. Let me just explain this. So what we are having here is just to we have the coupon. So like I said, the coupon here is 10%. You understand? So the coupon is the interest payable on bond. So once you say issue 10% at, so the coupon is usually with the the coupon is 10%. So what is the coin market price? At 142. Then the conversion is ratio is 30 ordinary shares. Like if the want to convert, that is the majority is 3 years. So the conversion, the value of the conversion dates, I mean the value at the conversion dates is that is equal to the conversion ratio, that is the 30 shares they multiply by the expected price, which is the 4.1 times the 3 years, increase is 3 years, as so you get the what do you call it, the value at conversion date. So this one is just is a little illustration just to explain the maturity date, the coupon, the conversion value, and the current market price. So those features, they are in this illustration, but this is not a practical and no, I'm not solving. I'm not solving. I'm just explaining the illustration. It just explain the features in what I explained earlier. So and this is not an examinable question at all. So you still have the one we retreat. So I just want to, so that we meet up and solve a one particular question before we leave today. So someone is raising his hand. Go Samuel.
Good evening, sir.
So good evening.
Good evening. Yeah, please, you made mention of redeemable bonds with embedded options, that they are convertible bonds. But I want to ask, can redeemable bonds with that embedded options be convertible?
Sorry, come again.
I said you mentioned about redeemable bonds with embedded options. And he said
Yes.
the characteristics are that they are convertible bonds. I'm asking
Yes.
if redeemable bonds with that embedded options can also be convertible.
No other the embedded options is the callable. The callable now you have the right but not obligation. So it's still a choice. The Z option is as an option for you. That's the portable one is also. So you have it gives the bondholder the right to sell back the instrument. So it's still a choice. Why the convertible also, it gives the bondholder the rights to convert. So it's not an obligation, it's just a right, it's just a choice. So if you want to, it's like it's embedded options. They are all redeemable, but you have the options to either sell, buy, or convert to ordinary shares. Do you get my answer correctly?
Yes, thank you, sir. Thank you.
All right. So bond with warranty attached. So a company might issue bonds with share warrants attached. So the warrant gives the bondholder right to purchase a specified quantity of the company's shares at a price specified on the warrant. So if the warrant is exercised, so it means new shares will be issued to the bondholder at exercise price. So the principal of the bond will not be cancelled or forfeited, unlike convertible bond, whose principal will be forfeited when conversion is done. So what this is trying to explain is that a company might issue bonds so that warrant attached to it. So and this warranty is actually give the bondholder the right to purchase a specified quantity of shares. So at a particular point in time. So when you are purchasing these shares, so I have the no the debt holder, but you have the guarantee to purchase the company shares in future. So when you are purchasing these particular shares, so the principal of the bond will not be cancelled. You still have the principal of the bond intact when you are purchasing the company shares in future. It will be a specified date. But in convertible now, when you are purchasing the company, at the conversion date, you have to so you are not a bondholder again. You are a shareholder from that conversion date. For this warrant, so even you might be a bondholder and still what do you call it, have a warrant to purchase the company shares. Did anybody get my question? The analysis here. So let's move forward. So the major differences, okay, from here we will get it. So the major difference between bond with warrant and convertible is that, so when convertible bond is converted to shares, you see, so as a convertible bond, if you are converted to shares at the conversion date, so the principal is cancelled. So the principal on the bond is cancelled. But if warrant is exercised, so if a bondholder and you have the warrant to exercise to purchase the company shares, so if what is exercised, the company is still liable to repay the principal. You still have the principal intact, unlike convertible that your principal will have to be cancelled. The number two difference between warrant and convertible is that, so when the warrant is exercised, so new shares will be issued to the bondholder. So and the bondholder will pay for those new shares issued. So, but when convertible bond is converted to shares, bondholder will not make any payment to the company. So, as a warranty holder, as a warranty, the bondholder that want to exercise warranty. So, if you are purchasing new shares, you will pay, of course. But as a convertible, you will not pay any amount of money before you make payments for a new purchase of new shares. Is the analysis clear?
It's very clear, sir.
All right. So let's move to debt covenants. So debt covenants represents the terms and conditions in a bond agreement, which prevents the borrower from carrying out some actions or making some decisions that affect its financial wealth. This
Hello,
covenant is
hello, sir.
hello.
Please,
Yes,
can
I'm
I
with
ask a
you.
question? Can I ask a
Yes,
question, sir?
yes, I'm with you.
Please, what is the benefit of the company, or before they can issue a bond with warranty, there must be advantage that the company will benefit before they can issue a bond with warranty.
So you are asking for the advantages of the company.
Yes, now there must be something that will be a benefit to the company before they can issue a bond with warranty, because it's an advantage for the bondholder that if it converted the bond to a share, he still have to the principal is still intact. What are the benefits of the company that source for funds to issue a bond with warranty?
Right?
So sorry, can I answer this question?
Okay.
As
You know,
if I
yes. Hello. Can you hear me?
Hello, I'm with you. Yes, I can hear you.
Yes. So the advantages of the company is that you attract more investors. You understand
Okay.
because So if persons want to come to you and they feel like this company, no, you have a preference of buying their shares while retaining your what do you call it, your capital.
Principal.
You
Okay.
understand? So under is that
Okay.
it improves the cash flow for the company because when the um when you have a bond holder, you are paying them and they're actually buying your shares. You know, it's a good cash flow for the whole company because you're having a more income. The income will be coming in. So also it signals the growth potential for the company because when they feel like this particular company, I can actually be a debt holder and buy their shares. So yeah, so it signals the growth potential for that particular company. Like this company is know what it's doing. So do you get what I'm trying to explain? So that's some of the benefits of for the company as well.
Thank you very much, sir.
Right. So it's some second. So the next one is of the their covenants. So so like I said, the covenant is part of terms and conditions that a bond agreement must meet. So and it restricts the what they call it, which is to prevent the borrower from carrying out some actions or making some decisions that will affect its financial health. So this covenant exists to reduce the risks faced by creditors. So covenant is just like what they call it, just like internal control. Let me put it that way. Put it so that once you borrow some money, so the money will not go away. So that the control put in place so that at least the debt so it's not bad. So those are like just control put in place. So we have the positive debt covenant and the negative debt covenant. So the debt covenant is state the actions that the borrower. Someone is raising his hand. Madam Stella, we are with you. Please, you can ask your question.
Good. I'm not asking a question, but somebody's mic is on. Your voice is echoing. It's sounding too. I'm not asking a question, but somebody's mic is on. Your voice
Saeed
is echoing.
Mohammed.
It's sounding too.
Saeed Mohammed.
Please, who is that? Please
Please, who is that, please?
mute yourself. Oh. Is it
Hello,
okay now?
sir.
Is it okay now?
Hello.
Hello.
Yeah, it's okay now, sir.
It's okay now, sir.
Okay. It's okay now, sir. I want
It
to
is
say that
okay.
somebody opened Google Meet. I also opened the YouTube.
It's re-echoing.
It's really going.
So I didn't get to say something YouTube now.
Somebody on YouTube, also on the Google Meet too.
Oh, okay. That's the
Oh,
reason,
okay.
right?
That's the reason, right?
So we are hearing you twice.
Please, the person
Please, the person
should
should
help us mute himself or herself so that we can have
The
a
person has
smooth.
muted.
Okay, that's fine. Thank you. So, like I'm saying, we have a positive debt covenant and you also have a negative debt covenant. So, a positive debt covenant is action. It states the actions that the borrower must do. So, as a borrower of a debt instrument, so positive debt covenants are the thing that you must fix through. You must provide when you want to obtain a debt instrument. So number one is that I provide yearly audited financial statements. So it's very, very integral. And reason being why is that so the debt providers rely on more or rely on a financial statement being audited by the auditors. So they feel like the figures set there shows a true and fair view, and it's prepared in accordance with the financial reporting framework and relevant accounting standards and audit standards. So they rely more on that. So if you prepare an account not audited and you want to obtain a loan, nobody will give you a loan. You understand? They feel the account prepared is not in line with the relevant accounting standards, and regulating framework. So financial statements is very, very key. So as a debt provider, so you seek for say a audited financial statement. So number two is that ensure compliance with relevant accounts. I've said that, so it's still part of the what they call it. So ensure that certain threshold is met in the area of financial issues. So if for you to obtain a debt instrument or a loan, so they will tell you probably what's your gearing. So if is the company not is not highly geared, so if you're highly geared, no company will want to borrow you money because they feel like you are running your company with more debts than equity. So nobody will want to borrow you, want to give you loan or borrow you uh, or invest in their debt instrument with you because they feel their their capital might be on stake or might be in danger. Understand? So next one is ensure regular maintenance of certain assets. So especially assets used as collateral for the loan. So as a um, um, as a borrower, so you must like have some assets in place, probably building, investment property, so and all that, so that to for you to serve as a collective security for obtaining that particular loan or debt instrument. So the negative part as a borrower is that to dividend covenant. No, all those ones they are positive. Like you must is are the thing you must do. You must provide before you miss the criteria for obtaining this instrument or loan. So the negative criteria. So number one is that the dividend covenant. So they might tell you that okay, well, if you want to obtain this particular debt instrument, you must not pay dividend for this particular years or period of time. So they might give you like okay, well, for it or for 2 years, might not pay dividend, or if you want to pay dividend this year, you only pay 20% of the dividend. So no, it's a restriction, restricting you so that once they borrow you loan and you make profit, you won't pay all what they call it, all the profit on dividends. You actually retain some part to for the payment of the particular loan. So number two is that the asset covenant. So they might tell you, okay, well, you must not dispose some certain assets. If you have a building, machinery, and all that, so in place. So it might restrict you to dispose some certain assets. So they feel like those assets might be as collateral or might be so that if you don't meet the repayment schedule, they might actually fall back to that asset and make a forced sales of that asset that make their own money. So they might restrict some assets for you. The financing also. So they might tell you, okay, if you want to like take loan from us, so that means you are not taking an additional loan from any company because if you are taking loan from us and you are going to another company to take a loan or bank to take a loan, it means the payment may not be easy for you. But at least if you are taking our loan only, so to pay us will be easier and be stress-free for you. Then the merger also, they might suit you that, okay, oh, this company should not partake in activity in the future. So if you want to borrow a loan from the company, they might suit you to match and so in the nearest future to match with another company. But if you match with another company, it might restrict you to make a loan repayment. So those are the negative and positive covenants of debts. So the next one we have the preference shares. So preference shares. So just I won't make much time on this. I'll just summarize this and then move to the question I want to solve. So preference shares are issued with a fixed rate of annual dividend. So preference shares, unlike ordinary shares, the dividend is not fixed. You understand? But preference shares, so the dividend is fixed. So they have a fixed payment of dividend. Preference shares are paid out of after tax profits. So preference dividend, like equity dividends, do not attract tax relief. So This is straightforward. So preference shareholder will be entitled to receive dividends out of profit before any profit can be distributed to shareholders as equity dividends. So if a company makes profits, so preference shareholders are categorized first before the equity shareholders. You understand? So they are categorized before the equity shareholders in terms the companies makes profit. The next one is that if the companies goes into liquidation, that means the companies wind up. So preference shareholders rank ahead of equity shareholders. So in the ranking, you have the debt holders, preference shareholders, equity shareholders. So they will rank the equity preference shareholders before the equity shareholders. So, but after, so that's just it. So we have the types of preference shares. So we have different types of preference shares. We have the redeemable preference shares. So it means so they are redeemable at by the company, typically at their par value as a specified date in the future. So redeemable preference shares so will not be redeemed. So one second we have the cumulative preference shares. So this means that when the companies make profits, or let's say the companies don't make profit for 2023, 2024, but they are making profit for 2025. So it means, like I said, preferred shareholders dividend is fixed. So doesn't mean because the company don't make profit 2023 and 2024, and they make profit 2025. So cumulatively, they will have to cumulate the dividend to be given to them for 2023, 2024. They pay all the dividend in 2025. But non-cumulative is that once the company don't make profit at a particular year, the dividend is gone. So if the company don't make dividend in 2023 and 2024, so in 2025, they will be paid dividend in the year the companies make profit. Am I communicating?
Yes, sir.
Yes, sir.
Yes, sir.
Yes.
All right. So also have the
Yes,
participating preference shares, and we also have participating preference shares. It means that it gives their owners the right to participate. Please, someone should mute his mic or a mic. So we also have the participating preference shares, so this gives the owners the right to participate to a certain extent. So that's all the profits when that is good there. So all this they are just something you can actually go. So convertible preference shares. So it's similar to convertible bonds. So the advantages of preference shares is that the annual dividend is fixed. So and so predictable. So for this particular year, so whether the company makes 2 million naira, 5 million naira as profit or 10 million as well, I know my dividend is fixed. You understand? So and the second one is that dividends do not have to be paid unless the company can afford to pay them. So I'm failure to pay dividends or like failure to pay interest on time. So it's not an event. It's not an event of default. So um so companies will pay present dividend when the so when so dividend do not have to be paid unless the company can afford to pay them. So I'm failure to pay preference dividend. So like failure to pay interest on time because you have to pay the preference dividend because it's like they're paying. So they prioritize the payment of preference yes dividend more than the equity shareholder dividend. Then its advantage is the preference shares is that so dividends are not an allowable cost for tax purposes. That's number one. Then number two is that they are not particularly attractive to investors. So because if you are optioning for a preference share, it means even when the companies so made robust profits or reach high profits, so it means your the dividend is fixed. You understand? So it might not be attractive to many investors. So then also, we have the factors that determine the source of finance. All these, they are what do you call it? That is not examining question. They might not ask directly that what are the factors that determine the source of finance. They would not ask you that what are the maybe they can just when they give you source of finance as a question. This can be like the at the bottom, like they might ask you. So what are the factors that are determining the source of finance because it's actually affect the equity part and the debt part. If you want to use equity or want to use debt, so these are what will determine whether of the two to use. So the length of the project. So if you want to invest in a project for a long term, so it means you are using a long term source of finance. So this is practicable. So just depending how you understand it and how the pressure comes, we make you to buttress the point on it. So of course the cost of finance. So the interest rates. So if the interest is high, if you want to go loan and the interest is high, of course you option for alternative source of finance. So repayment terms. So if the if the payment terms is not favorable to you, so you can actually option for other source of finance. Then the business size. So if the business is small, so of course you can, or if the business is not quoted on the floor of the stock exchange market, of course you can't issue shares. So you can only rely on the, probably bank overdraft or medium short of source of finance. But if the business is large or quoted on the floor of the stock exchange market, of course, you can issue bond and raise um, and issue shares. So then the control consideration as well. So if the owner, from question number three, the owner is strict to the owners of the business, so they avoid equity or they don't want to dilute their ownership. So what alternative source of finance can, you understand? So the control consideration as well. So if the owners restrict their control consideration or they don't want to dilute their what do you call it, their ownership or control, of course you can switch to alternative source of finance, probably debt and all that. Then the risk profile. So if it's involves high risks, high potential risks. So if you know, okay, if you want to invest this particular needs, the risk will be high. So you can actually switch to other alternative source of finance. So all this actually determine the factors for you to consider when you want to option for any source of finance. So am I communicating?
Yes, sir. You are, sir.
Yes, sir.
Yes,
All
sir.
right, all right, thank you. So this is an icon question. So see, can someone assist us with this?
Read it.
Yes, please.
Okay. Can I
So who
read?
can assist us? Yes, you can
I
go on.
can I
Thank you.
okay. Illustration 2. BJ
Okay,
PLC is a
okay,
medium-sized manufacturing company which is
okay,
considered a 1 for 5 right issue at a 15% discount to the current
okay,
market price of 4 naira per share. Issue
okay,
costs are expected to be 220,000 naira, and this cost will be paid out of the funds raised. It is proposed that the funds raised from rights issue will be used to redeem some of the existing debenture at par. All statement of financial position, all figures there are considered to be right.
okay,
Yeah. So okay. Other information. 1. Price earnings ratio of BJ PLC is 15 naira 24 kobo. 2. Overdraft interest rate 7%. 3. Income tax rate 30%. 4. Sector average debt slash equity rate, that is book value 100%. Interest cover 6 times required. A. Ignoring issue costs and any use that may be made of the funds raised by the right issue. Calculate Roman figure 1. The theoretical extract price per share. 2. The value of the rights per existing share. B. Calculate the current earnings per share and the revised earnings per share if the proceeds of the rights issue are used to redeem some of the existing debentures. C. Evaluate whether the proposal to redeem some of the debenture will increase the wealth of the shareholders of BJ PLC. Assume that the price/earnings ratio of BJ PLC remain constant. The last and not the least, D. Discuss the reason why the rights issue could be an attractive source of finance for BJ PLC. Your discussion should include an evaluation of the effect of the rights issue on the debt to equity ratio and interest cover. Thank you, sir. I think that's all, sir.
Sorry,
Hello?
sorry, I thought I'm muted. So thank you, Mr. Motala.
You're
Thank you
welcome,
very
sir.
much. So you can see this is a practical question and examinable question. So this is like a 20 marks question on source of finance. So you can see it includes your equity part and the debt part. So these are some questions we're expecting in the exam. So come let me. So on the question now, so what's the issue we should calculate? So number one, ignoring the issue cost and any use that may be made of the fund raised by the right issue. Calculate the theoretical XY price. Okay, let me stop sharing and sorry, I'm coming. Let me. Please, can you see my screen?
Yes, sir.
Okay. So from our
Yes.
so number one, right? Number one A. So what is this we should calculate?
Theoretical exercise
No,
price.
extra price per share.
Okay, to calculate the theoretical excess price. No, but in the question we are told that the right issue is issued at a discount, right? You know the right issue is not issued at par.
Yes.
So that means what's our right issue? What's our right issue? I mean the number of shares we have.
1 to 5.
No. I mean the what they call it. What's the I mean the current market price of the shares?
£4 per share.
So we have for 4 naira per share, right? So and the discount is 50%. If you have to discount it, it will be 0.85. I mean 85% if you are to discount it, right? So what are we having at the current market price now?
3.4 naira per share.
3.4 naira.
Please hope we are on the same page on this. No, the coin market price is 4 naira. So assuming we are not, it's not issued at discounts, we just will move forward with 4 naira and do our normal calculation of TAP. But we are telling us the shares is issued at discount. That means of 50%. That means we have to reduce the coin market price by 50%. So that's why we are reducing it. Then to calculate our normal, what do you call it? Our normal TAP. So how many shares are we having? Like 5% share, right? What's the amount?
4 naira.
That is 4 naira, right? So we have how much?
20 naira.
20 naira. So what's the right issue? The new share.
One
3.4
new share at
naira.
40.
3.4, right? So what are we having? We're having 3.4. So what are we having now?
23.4 naira.
23.4 divided by 2.
23.4.
So this so this who is on normal test. So what do we have now?
3.90 kobo.
3.9.
Okay. So that is it. So that is on one is so what is true? What is this we should calculate into? I have to
The
go in back
value
to
of
check.
the right per existing share.
So what is value of the rights now? It should be to its correct price, right? It should be the type minus the new share. So what's the top?
3.9.
So minus what?
3.4.
So we have what here?
0.5.
0.5.
But if you want to calculate the value of rights. So the value of right per existing share will now be 0.5 divided by what? Per existing
5.
shares.
5.
So that what?
10 kobo.
Right, thank Bobo. So that is A. The one B. So we have gotten our A, right? So one B. What do you should calculate? Are we with the question? Because I have to stop sharing and be going to the question again. But if you are with the question, you can just be um
Calculate the
checking the
current
question.
calculate the current earnings per share and the revised earnings per share of the proceeds of the rights issue, if the proceeds of the rights issue are used to redeem some of the existing debentures.
So calculate EPS, right?
Yes.
So what we have to know the what they call it. So what's the existing EPS? So if you want to get the our EPS, what's the calculations for EPS?
I think EPS is price earning ratio all over market value, right?
Huh?
So what they call it, this is existing EPS. So use the like normal price earning ratio for it, right? Like let's say we use
Yes.
the
EPS. Okay.
we use the price we use the price earning ratio. So what's the current EPS? What we have the market price, right? What's the current market price?
4 naira.
That is 4 naira. So if you want to use the normal price earning ratio, it will be what? We have the market the market price per share divided by the sorry. If you also use the normal do you have the normal price earning ratio currently?
Yes, we do.
It is a question now. Is what's the price earning ratio in the question?
15.24.
15.24.
15 naira
Okay,
24 kobo.
so they make our this thing easier. So so that is to get our EPS now. So EPS equals to our market value per share divided by the price earning ratio, right? Are you on the same page, please? If you're not getting it, please kindly signify so that we can explain. No, we want to get the EPS, but we have the NPS already, and we have the price earning ratio already. So for us to get the EPS, just the market value per shift is the 4, divided by the price earning ratio, which is 15. Is that it? Is it not correct? Nobody is answering me.
It's clear, sir.
It's clear, sir.
So what are we having? What's
So
the
what are we
EPS
having?
now?
What's the EPS now?
Please,
Please.
mute your mic, mute yourself. Oh yeah. What are we? What's the EPS?
0.26.
26, right? Okay, that's the EPS. Okay. Then what's the number of shares? What's the number of shares? Yeah, now check the question. You see the under equity. What's the number of shares?
2,000.
2,000.
So that means it is in million. It is in thousand, right? That will be 2 million. Is that not?
Yes.
So what's the right? So what the listing be?
1 million.
Right. So for us to get the total earning now. So for us to total earnings, to know the total earnings is like the profit after tax. That's EPS times the number of EPS that the number of shares. What is number of shares? What is EPS? Oh yeah,
Sir,
yeah. What's
I just want to
EPS?
tell you how to tell you that
0.26.
to explain the presentation now. You must go to the sir. If you want
So
to
what are you saying? I
explain
can't hear
it,
you very well.
you must go to the instrument why they use the
I
lecture
can't hear you
for
I can't hear you very well. Please come again.
sir.
Hello, sir. Please, can you
Yes,
increase
sir.
the
Please,
So,
I can't hear you. Probably just come. I can't hear you very
sir,
well.
sir,
Okay.
I,
Okay.
sir,
Okay. Can go on.
sir.
Please mute yourself. I can't hear you. Mute yourself first. I can come back again. I can't hear you very well.
Hello, sir.
Oh yeah, now you can go on now.
Sir, please,
I'm
can
with
you
you.
increase your font size? It's very tiny over here, please.
Okay. Sorry.
Chinyere, please, can you mute yourself?
Is it clear now? Is it okay now? Is it okay?
Yes, sir. Yes, sir. Thank you.
All right. Thank. Please, Miss Shiri, mute yourself. Mute yourself, please.
Sir, please remove her. Remove her from the call. What's all this?
What is all this now?
Please mute her, sir. Remove her.
I think it's Lucas or who?
Please, can she be taken off the call if nobody can reach her?
Let
Maybe
us
she's
remove
not near
her.
her
She's
phone or
disturbing the
something.
Yes,
Please, you
platform.
can remove her from the call.
I'm even trying to remove her, but I think no, I was sent the meeting, so I'm even trying to remove her. Maybe it's service or maybe I don't even know because it's not even.
If you are not
Wahala
the host of
promise.
the meeting, you won't be able to remove her.
You
It's
said?
only the host. It's
It's
only the
only the
host that
host
can
that
remove
can
her. The
remove
host
her. If
that
you
can
are not the
remove her.
host, you won't be able to remove her.
It's only the
So
host.
what's she's delaying us? What's all this?
Maybe she has slept off. Please see. Maybe she's not even there. Irú wàhálà wo lélẹ́yìí báyìí torí Ọlọ́run?
But is she the one at office or what? But this I'm just as if she's a carpentry
Just the
workshop or
lecture is still
something.
on. Just a piece of this. I didn't finish. Now my lecture is still on. Have I finished?
Chinyere, mute your mic. Mute your mic, Chinyere.
Please, you are disturbing us now. Irú kí leléyìí torí Ọlọ́run?
You guys word war. Who's saying word war here? You guys are funny. Oh my god.
For this one, I'm glad you.
Oh my god.
Sir, please remove her now from the call.
I can't remove her. I'm not the host.
She has
I can't
muted
remove
her
her.
microphone, sir.
Mr. Sherry.
Adeshina, mute your microphone, please. Okay, she has done that. I think we are good to go now, sir.
God. Okay. Please,
Sorry,
what's the?
We are very sorry,
So
sir.
what's the end per now?
1,040,000.
1,040,000.
Okay. Right. So what we are asked to calculate again. So this is the total earnings. So what's the next requirement?
Revised EPS.
That's not all. They told us to calculate the current EPS and the revised EPS if the proceeds of the rights issue are used to redeem some of the existing debentures.
So this is the before the what they call it, right?
That's the current EPS before they revised it.
So we are calculating the revised CPS now, right?
What was the price? Value of the share.
So let's say the post right EPS. So do you have any additional shares? Any additional shares? Because you have to add additional shares to the current shares we are having. So what's the additional shares? Additional number of shares. So this is the theoretical extract price, right? You guys are not with me. Or so what's the share? What's the share? What's the number of shares?
2 million.
Is it true?
No, it's 4 million.
The number of shares 1/5 times
1 million.
shares.
Times 4 million.
So what's the additional shares we are having?
It's 800,000.
800,000.
So what's the existing shares?
1 million shares.
How does this share was be 1 million?
Sorry, 4 million shares. Sorry, please.
Okay. So what's the total distance we have now? We have 4 million, we have 8 million, we have 800,000. So the post rights
Because right number of shares will be 3 points.
What? 1,800,000.
right?
Okay.
So and we are told if they will raise what they call it, right? If they are to raise how much?
2 million.
This skip or not just so this is a new this thing they are raising, right? So the gross funds to be
So
raised
the
is
gross funds to
800
be
million.
raised is 800 million.
Please mute yourself, oh, mute
Please
yourself,
mute
please.
yourself. Oh, mute yourself, please.
Who is this again?
Who is this again?
Salushegun.
Solution.
Hello.
Hello.
What's the meaning of this
Another
now?
person has
What's the
started
name of this?
Oh my god.
Oh my God.
again.
At least if you want to ask a question, you can only
If
need
you want to
some this thing. If you have a question to
ask a
ask.
question, you can only need some
This one too is
question
even maybe
to
you are in a
ask.
train or you're
This one
in
too
a
is
carpentry
even
workshop, you
maybe
don't
you are
even
in
know.
train or you're in a carpentry workshop, you don't even know.
Wow.
Wow.
Please can you continue? So
Please
the
can you
ghost fund
continue?
to
So
be
the
raised
cost fund to be raised
will be how much?
will be how much?
No, you are using the venture now.
No, you are using the venture now.
That means you are using the what they are telling us is that if we
That
calculate
means
the
you are using
current
the
earnings per
Babika
share and revise the earnings per share if
the
the
current
proceeds
earnings
of the
per
right
share
issues are
and
used to
revise the per share
redeem
if the proceeds of
some
the
of
right
the
issues
existing
are used to
debentures.
redeem.
So
So
this is what they are telling us. So
this
if
is what they are telling us.
the God
So
funds to be raised now, this one is because the 800,000 is like the what they call it additional shares you have, then multiply by the current market price, then multiply by the discounts. So you have the ghost fund to be raised. So how much are we having?
2,720,000 naira.
Do you have any issue costs to less from it? No, this is the ghost fund. Ghost fund. So you have any issue
Yes,
costs? You have to less from it.
220,000 naira.
Hello, sir.
Hello.
Hello. Please, sir, how did you get this 0.85?
Is the discounts? The 4 million 4 naira is the current market price, and we are told it's on the it's on discounts. We are assigned 50% discounts. You have to less 50% from the 4 million for the 4 naira.
Thank you, sir.
All right.
All right.
So what's the issue cost?
220,000 naira.
Okay. That's deduction, right? So what are we having?
2,500,000 naira.
Uh, 2,500,000. Okay, so that's the net fund to be to raise. That's the net.
So please, you said that 15% of the 4 naira gave us 0.85, but that's not the answer. Sorry, I got 0.6.
50% of no
15%.
the at par is if you're using at par, you are using that is 100%. But if you're using at discount, that is no at par, at discount and premium. Understand? So if you're using at discount, that is 50%. That is the remaining be 0.85%.
Okay, thank you, sir.
Hello, sir.
Yes, yes. So
Yes.
this amount we have 5 minutes to raise now, and we are do you have so this is the amount to be raised, but we are told in the question that if you want to use needs to raise the venture, how did they mention it? That if the proceeds of the right issue are used to redeem some of the existing debenture. So if you want to use the proceeds, this is the proceed now to issue the debenture now, will not be let's say that is the debenture interest. To save. So this is that you are using the proceed from this, the proceed from the right issue, the so what's the percent of the debenture?
12%.
That's right. Do you have any tax? Do you have any tax?
Income
No,
tax
it's
rate is
extra
30%.
30%. So that is right. Are you on the same page? So what are we having? What we having?
21,000.
21,000. Is that what should I no should more than 21,000?
210,000.
Oh, so this is the venture interest to save. You understand? So to now there are revised what they call it now. How is this in manufacturing? So our revised earning is now so after tax. So our revised earning after tax. So what's the earning after tax? Do you have in the question the come here? Let me check the question again. Are we giving the question? We're not giving the question, right? So what's our revised earning?
So
But
can you look at this
but
total gross fund raise? Gross fund raise 2.720. You remove 10 there.
Oh, thank you. Thank you. So this is just the debenture interest, sha. So this is that's the debenture interest saved. So like that is 210,000. So that's the we are just asked to tell to the right issue to you used to redeem some of the existing debentures. So that's the debentures interest to save. Then maybe I will so that I won't delay us. So what's they asked to calculate and say? What are we to calculate and say? Read the question now.
Um, Evaluate whether the proposal to redeem some of the debentures would increase the wealth of the shareholders of BJ PLC. Assume that the price earnings ratio of BJ PLC remains constant.
So what we're saying is that no price earning ratio now it when it remains the same. So it means the share price will remain 4 after the right issue. Like if the price earning ratio did not increase, so it means someone is raising his hand. So Mr. Chika, please we are
Good
with
evening,
you.
sir. Good
Okay,
evening, sir.
Mrs. Good evening. Good evening.
Well done, sir. Please, we are asked to calculate the existing EPS, which you have calculated, and then the revised EPS. I think we have not finished that question. I mean, the second part of the questions.
So you are asked
And
to calculate the revised CPS, right?
yes,
Okay, and the revised earnings per share if the proceeds of the right issue are used to redeem. Let me go back to the question itself. So what's the revised earning after tax? So what's the earning? That's 2.5, right? 2 point what's the earning itself?
our former earning is 1,040,000.
Okay, well, if you remove tax income, what should you have? So 1,040,000, right?
Yes.
So if you remove the what they call it, if you remove the tax, the revised earning is, let me check from here. This is the revised EPS, this is 800,000. I'm coming. Do you have the revised earning here? I'm checking. This is total earning. This is the revised EPS. Total earning is 150,000, right? Okay, the 140,000. Oh, okay. Sorry. So if you want to, so the revised earning, right? So what's the revised earnings now? 1,040,000.
plus 210,000.
1,000,000. So what should we have now? What should we have? 1,250,000.
1,250,000.
So, and since we have the revised and you have the revised CPS as well, right?
Yes.
So, so the revised CPS is 1,250,000, right? So our IPS is what? Our IPS is the market, the earnings over what? The number of shares.
Number of shares.
So what is the number of shares? Like the revised number of shares, so that is 4.8 million.
4.8 million.
So what should we have?
26 kobo.
0.26.
0.26. So we will check if there's any effect from what they call it, from the no. What we're trying to do is that if you want to check if you incorporate in the venture, you understand, and revise the normal what they call it, earnings and APS. So will it have same effect if the venture is not incorporated? We can say there is no effect. So from the what they call it calculated now, you can see how we have the same amount. I don't know if you get the what they call it. So if you compare the venture, it means you won't be the your answer will still be should be the same. So from here now you are having 0.26, and also here our EPS also here when this is not compared is 0. EPS is also 0.26. You can see, right? Are you on the same page? So there
Yes,
is no
sir.
effect. So
Yes,
there is no
sir.
effect.
Yes,
It
sir.
just so it just comments. There's if you have any comments, so no. So no if effect. So no effect of EPS. You just comment normally. So that's just it. Okay, let's move forward. So what's shows you calculating say?
Evaluate whether the proposal to redeem some of the debentures would increase the wealth of the shareholders of PJ plc. Assume that the price earnings ratio of PJ plc remains constant.
So as we all know, the price this thing is same thing. So the price earning ratio so it's same. So it's same thing. So the price earning ratio is still remain the same. So if it remains the same, that means the share will remain at 4 naira after the right issue. So the share price will not change. Hmm? So, but do you have what is our tab here? I'm trying to just to discuss. So, what's our tab here with the TERP? What do we have on our tab? I have 3.9 or so, right? That is
3.9
the
kobo.
theoretical exercise price. So that means that the share price will remain for 4 naira after the right issue, but the theoretical exercise price is at 3.9. So this implies that there will be a gain of 10 kobo. So that means the proposal to use the right issue to the right issue fund to regain part of the debenture will result in increase in shareholders' wealth. I don't know if you get it, the logic. So
Please come
the
again.
price. Okay, let me put it this way. So the price anniversary is same. So the tap or the share price will remain. So the share price remained what they call it remain. Is it not? Or this right? So we now explain that. So the proposal to use the right issue, the proposal.
Hello, sir. Please help us to space that A from the gain.
Which one is it? Where is A? Where is gain?
That the share will be a gain of
Okay.
not
Okay, I've
a
done that.
gain.
I've done that. Ah. So do you get it now? So it means the price earning ratio is the same. So however, so the share price will remain funny after the right issue, while the tap is 3.9. So this implies that there will be a gain of 0.1 per share. So thus, therefore, the proposal used to use right issue to redeem part of the debenture will result in an increase in shareholders' wealth. So that's just it. So that they also ask for the implication. Do you get it? Hello, are we there?
Yes, sir.
We are there, sir.
Okay.
Okay.
So what is
So what is now?
number D? What are we asked to do in D?
Discuss the reason why a right issue could be an attractive source of finance for Benjer PLC. Your discussion should include an evaluation of the effect of the right issue on the debt stroke equity ratio and interest cover.
Hmm. This
This
requires
requires
they're asking much. That. So So what they are asking is that if you are using what they call it, the debt ratio. I mean, they usually, you say we should use the gem, right? Okay, this discuss the reason why a right issue could be an alternative source of finance for BJPLC. Okay, the discussion should be include an evaluation of the effects of the right issue on the debt equity ratio and interest cover. Okay, okay. So that means we are using it we are using it of the debt equity ratio, right? So if you are using the debt equity ratio, let's say no debt to equity ratio is just the GM ratio, as we know, right? So let's say scenario one. So if you're using whether the debt or the equity ratio, so what's the debt? What's the debt value? What's the debt value from the question? Oh yeah, now you see people are fasting tonight. Oh. What's the debt value from the question? I thought we have the question with us.
100.
You said
100.
no debt. What the debt value from the question now?
1.5.
4,500, sir.
Mm-hmm. So what of equity? All right.
Equity is 3.5.
Okay. Equity is 35. So what will be our the debt to equity ratio? So what we have? Oh yeah now. Our debt to equity ratio is what?
1.29.
1.28.
29.
1.29. 1.29.
1.29.
1.29.
Yes, sir.
9%,
That
right?
makes sense, right?
So this scenario one, no scenario two now. If you want to incorporate the bank overdraft, bank overdraft too. So it's part of debt. Like if you're using what they call it, that's in other cases. So bank overdraft is also part of debt. So if let's say this scenario one and this scenario two. So that's still the same. So we have what's the overdraft figure?
1,250.
That's 1,250. So what
Debt
will be the debt figure now?
debt to equity ratio give us 1.64.
Hmm.
Five
What did we?
seven
What's the
fifty.
other?
5750.
So what should we have here?
1.64.
1.64.
So that is the so scenario that can occur. So if you're now having what do you call it? Let's say the if you have it incorporate the what do you call it? The no, they say we should incorporate the what from the question. From the question, what are we asked to? So the question to include an evaluation of the effect of the right issue on the debt equity ratio and interest cover. Okay, effect of the right issue. So from the new issue we raised, from the new shares that were raised, no, we have additional 800,000 shares, which give us the net fundraise after we reduce the issue cost. We have 2,500, right? Is that not so? People are not with me again now.
Yes, sir.
Okay, let's just
Okay,
put
let's just put it
like
like
let's say the expected position. The expected position. So minus right to show.
Sorry, sir. Is debt to equity ratio supposed to be in percentage?
That would yes.
It's supposed to be in percentage. I thought it was supposed to be in ratio.
Oh, sorry, I this is 129. Then this 164. You get right? Is that what you're saying?
No, I'm saying I thought it wasn't supposed to be in percentage, that it's supposed to be in ratio instead.
Yeah, this is in ratio now, it's not in percentage.
Okay.
I didn't get what I'm saying.
Yes,
To
sir,
be in
I
a ratio now,
understand.
yes, 125 129%, then 164%. So this from scenario one now, you have the debt. So what's the debt figure now? 4.5, right? So what's the amount raised? I mean the net amount raised is 2.5. So what should we have here? Oh, yeah, please, this is equity.
2,000.
So this is equity. So what do you have in equity? Equity is 3.5. Ah, where is this thing going? What did you have here?
2,000,
This is 2000 to 2000. This is what?
1,000.
No, in debt, you remove it from debt. For equity, you have to add it. Do you know why? You know is that
We are issuing additional shares with the
exactly,
2.5.
yes. Exactly. So this is what
6,000.
6,000.
So our D, what's our D?
0.33.
0.33.
Lisa,
That's tight.
can you explain why we removed 2.5 from debt and we added it back to equity?
No, we are not even going back and adding it back. Oh. So from the question, this things is used for the venture. From the question, that we are told that discuss the reason why a right issue could be an attractive source of finance for BJPLC. The discussion should include an evaluation of the effects of the right issue. Sure, you understand. So the what do you call it? The net, we raise a fund now. We raise additional fund of 2.5 from this, and so it's added to equity. Do you get what I'm saying? Like you are issuing a new shares, not a debt.
Okay, sir. Thank you.
So the scenario 2 now, what are we having in scenario 2?
We'll be having 2 million plus the overdraft.
I 4, 5, right?
4.5 minus 2.5, that's 2 million plus the overdraft of 1.250. That's 3,250.
To 15, right?
I think scenario 2 should be 750.
750.
Yes, minus
How is it 750?
that's debt for plus overdraft. Are we now adding overdraft?
No, overdraft is plus debt now. Is no, you have 2,000 before, then plus overdrafts. Is 1,350.
Okay,
I don't
okay.
know what. So what are we having here?
0.54.
That's 54, right? So what is the implication here? So the implication is that if the right issue is not used, it's because you use the right issue. That's why you're having 800,000 additional shares, which gives us the 2.5 million naira that was raised. You understand? So the implication is that if you are using the right issue, would just have this changed. So the implication is that if the right issue is not used, it's not used to redeem the venture. So the decrease in gearing is less. Do you get logic?
No, sir. Come again, sir.
I didn't get it.
So what I'm saying is that no, we are asked to us explain the implication. So this is an analysis, like just interpret. So if there isn't right issue, so with the what do you call it, increase or decrease. So from here now, if as you are using the right issue, the what do you call it, decrease the debt to equity ratio
Yeah.
decrease. You understand? So it does not decrease, so it decrease. So from 129 to 33, then from 164 to 54, so it's decreased. I mean, so you are less prone to, so you are less jet. You are not added jet. If you added jet, that means the debt will be more than the equity. But now, since you raise additional shares, so the equity we raise from the right issue have what absorbed the debt. Is that, are you on the same page? Do you get it?
So I have a question.
Okay.
Some of the advantages of debt finance is that it's cheaper. Then why are we seeing the equity finance being cheaper than the debt finance?
It's not cheaper. Oh. That's the company motive. Oh. The company say, okay, oh, they want to, okay, if as a company now, most of the, what do you call it, the companies that are quoted, of course, you have equity and debt. So you can't do without the two. So you raise shares in the, you raise shares, then you have the ventures and all that. So, but if you want to raise funds, okay, let's say this issue of bank recapitalization now, no, company have to raise funds to make the cap policy. Do you understand? So let's say the company need 2 billion naira. So they can't say they can't be going to seek bond and the venture all over the distance. So they have to raise new shares to take
Okay,
to
that's
have more, for them to have more funds, more finances.
okay.
So
Okay.
and the alternative source of equity is TAP, the right
Okay.
issue. So if you can, it's usually you use a private placement or public issue or the right issue. So since they don't want to go to
Okay.
the public, to be announcing that you want to issue share low, you can just make the existing shareholders and tell them, please, okay, if you're having four shares with us, you are giving 1 shares. You understand?
Okay.
So and they do that for all the shareholders. So if you're having four shares, you are giving 1 additional shares. So that's the alternative source of finance, rather than going to the public to make a publication.
Okay.
So that's what they want. You see what I'm saying?
Okay. Okay. I
So
have another question. Okay. What is the best method of source of finance to an organization? What's
there's
which
no
best
best, there is no best. It just depends on, no, we have the advantages and disadvantages. Equity has its own advantages, debt has its own advantages. It's just based on the factors I listed earlier. Like I said today, that is very important. That factors affecting source of finance. So is that factor you will look, okay, oh, if you're a small company now, so the source of finance we use will not be the source of finance a company that is bigger will use. So if
exactly?
so, and also the risk profile. If
Okay.
you are not a risk lover,
Absorber.
so so you might not want to risk what they call it, maybe take loan and all that, but you might not be able to repay, and it might affect it might affect the company's brand and profile. So you might go for other alternative source of finance. It depends on the factors surrounding the source of finance as we listed earlier. So you go through the factors. So it will guide you on the source of finance you can take as a company. So you can't say as a company, oh, this source of finance that will be okay for you. No, you have to consider those factors
Factor.
for you to choose the best source of finance.
Okay. Thank you, sir.
And so I think we done with the question, right? Are we not? Well, what issue we should do again? Okay, the interest cover,
Interest
right?
cover, right? Interest cover.
Okay.
Okay.
So this one now, the what do you call it? Just if the companies the narration, if the company use right issue, so the company will less jet. Since from the so if the company issue right issue, so the debt issue ratio is 3.33%. So why if you don't use the right issue, it will not 29%. So that's just the narration, and for the scenario two as well. So this is D1, Abi. This one is this one is D2. So what's the so and for us to get the interest, we have what they call the earnings before interest and tax. So do you have it in the so what's the our earning? So we have the EBIT, the earning before interest and tax. So what's our earnings? From the question, what is our earnings? From the what's the earning before tax? That's 1 million something. One million, I don't know,
1 million.
40 million,
40
abi?
million, abi?
40,000,
40,000,
1
1
million.
million, 40.
So earnings before interest. So this is earning before tax. So what's our tax rate?
30%.
Um, what are we having? What are we having?
728,000.
7.8.
728,000.
No, it can't be. Is it 728,000? No, wait. So earnings before tax. From here, earnings before interest and tax. No, this one is earning after tax. You understand? This 140 something is it after tax or any before tax? This one for where do you get this?
Is
You
after
can see
tax.
it is up, so we have to remove the tax elements. They get so for divided by this. So let's get the tax elements. Do you understand?
No, sir.
This 104 is any after tax. So, but what we need is any before tax. So just instead of multiplying, assuming this 1 million 40 is any after tax, so you multiply it by this, so you get the what they call it the earnings after. But this particular is any this one itself is any after tax, but we need any before tax because to calculate EBIT, so it is any before tax. But this is any after tax, so just remove the tax from it. Do you get
1485714.
1
Four
4
eight five 714.
714, right? So if you add this earning before interest, so interest. So what's our interest? So we have interest on the venture, right? And interest on what again? An overdraft. Those are the two. Did you have any interest on this thing? Any interest on overdraft? So what is our the venture?
Yes, there's 7% interest on overdraft.
Okay, that's fine. So what is the venture? What is our? Do you have any? What is the venture figure? And we have what is the venture? Oh
Two
yeah, now
five.
the is 4.5 now. Abi,
Is it not 2,500,000?
2 million. Where is it?
Okay,
Where is it to
okay,
11,000?
okay.
Is
Four
debt
point.
our
Is
debt
debt
now?
our debt now?
The interest you are
Zero
paying
The
of
point.
interest you are
debt.
paying of debt.
Oh yeah. What do you have here?
540.
540.
540.
540.
Is it in thousand?
Yes.
Okay, overdrafts. What's that? What's the over that figure?
1,250.
Is it million or thousand?
Million. 1,250,000.
Which one is a million, Abi? Please, let's be conversant with this. So what's the percent?
7%.
Okay, let me just put 0.07. So what do you have here?
87,500.
7,500. So what do we have altogether?
627,500.
No, plus the any now, and everything, any before interest and tax. No, this is just the end. This is just a.
Two
So
million
add
one hundred and 113,000.
2 million one.
113,214.
It's
So
really enough, guys.
you said. So you are saying something. So this is a bit. So the any before interest and tax. So that's a bit. So, but you know, the any before interest and tax is not affected by what the company wants to invest in. They wants to, like, I mean, their decisions is not impacted by this any before interest and tax. So the total interest, what will cover is want to what the total is the interest cover, right? So what's the interest element now? The interest element is just this two. Hmm? Do you get just this as the so what we have
627,500.
is 627,500. So that's the interest model for this element. So to not get the interest itself, I mean the revised, no, this is the normal interest, but if you want to calculate the revised interest, or let's calculate the How should you calculate it? Um, this two 500. So what's the interest cover? What's the what's the formula for interest cover? Like any of interest, right? What's the formula for interest cover?
PAT over interest.
There's a profit after tax.
Profits before interest and tax over interest expense.
It's not PAT, it's EBIT.
It's EBIT. Earnings before interest and tax divided by interest expense.
Okay.
So what is our that is 2113, Abby? 214, right? So divided by 627, right? Yeah,
3.37.
3.68.
say the same
Say the
thing.
same thing.
So
So 3.3 point
6.
It's 3.37.
That should be number
should
of
be number of
times.
times.
So you move this
So you move
now.
this now.
So that's
So
all about
that's all about
your
your
question.
question.
You can see this
You
is
can see this
a robust
is a
question
robust
that
question that
please mute your
please
mic.
mute your mic.
Please tell me
Please tell
ruler
me
now.
ruler.
You can see this is a robust question that combined both equity and debt together. So these are a normal typical example question. So you should be expecting. So we just like focus on, you can see the tab, the debt, and they are retreated. So just recover stands with the normal maybe tab and all that. So that's around the source of finance. So do you have any question concerning this? Do you have any question? I think there is no question. So in the absence of no question, so I will find time to check for other what do you call it work work exercise that's probably in as much as possible, that then the question I can solve and um put the answer as well. I mean some question pack and answers that I will share with you guys, so that once you go through the questions about concerning source of finance, equity and debt, you can also be reviewing the answer. Then if there's like no that is not that you have an issue with and concern with them, you can actually treat that together.
Okay,
I
sir.
think that's fine.
Sir, can you share this one?
Of course, I will do that. Yes,
Okay, thank you.
I will convert to PDF and send to you guys.
Okay.
So that's that on source of finance. What I'll just do for source of finance now is just to share the some bank as I said, but that's that on source of finance. So equity and debt. That's that. So next week we'll go to another topic entirely. But if you have any concern on source of finance, you can actually reach out and we can actually discuss and what minds on it. So thank you for your time, and I wish you guys success ahead. Please, if you're not start preparing. Start preparing. So just give it time, and I pray may all of us excel.
Thank you
Amen.
so much.
Thank you, sir.
Amen. Thank you very much, sir.
You're welcome.
You're welcome.
So,
So,
although that's it for tonight. So I wish you guys
Thank you, sir.
a wonderful Sunday ahead.
Thank you, sir. God bless you.
Thank you, sir.
And you too. All right. Have a nice night, and take care of yourself.
Thank you. Bye bye, sir.
All right. Thank you.